Strong agricultural performance in Kenya has grounded inflation, encouraging policymakers to hold the key lending rate at single digits. Despite a modest inflation rise in June to 4.9%, Kenya's economic outlook remains positive.
We are very optimistic. We're seeing our clients drawing on more facilities, raising equity capital just like we are. We're seeing our clients raising equity capital. So I see a lot of potential for growth over the coming years. The one danger that we sense is government spending. We believe that governments, more accountability needs to be put in place for the way government is spending their money, because there's a danger that government expenditure is going to raise taxes and also crowd out private sector investment.
In terms of the economy, I think the economy is strengthening. We have seen in the last 3 months the economy has picked up back again. We expect the economy to even further grow with the changes which are taking place. So economic challenges, no.
If you look at the macroeconomic environment, it's looking much more stable. Inflation is remaining fairly low. We expect it to remain within the single digit. 5 to 7% is a target by central bank. If you look at the exchange rate, that is looking fairly stable going forward. So more stability on the macroeconomic environment. If you look at also in terms of growth of companies, obviously from a demand perspective, because as inflationary pressures also remain low, then obviously the consumption power for the citizen is obviously higher. So we expect the risks have significantly come down. So from a lending perspective, we expect obviously with low treasury securities returns, then obviously banks also to be able to grow.
Recent data from Central Bank indicates loan applications rose threefold to over 85,000 in May, while total loan books grew to over 1.4 trillion shillings. This was despite double-digit interest rates in commercial banks, which remained a sore spot for private sector.
Yes, it does slow down the economic growth. I mean, from an institutional point of view, yes, it does slow down the growth. What other impact does it have? I mean, the good impact it has is that it controls inflation inside the economy. It also ensures that the savings growth inside the country increase because the interest rates are high. So everything has got a positive and a negative. So if we look at the rates which are prevalent at the moment, yes, it supports savings. Yes, it supports lower inflation. But does it support economic growth? No, it does slow down economic growth. So we are a developing country. We need to have a fine balance between growth, savings, and inflation.
Unfortunately, this market and I think the region where we operate, there is no savings culture. Okay, the savings culture. Given there is no savings culture, banks typically need to pay a high sort of interest rate to attract those deposits. So whereas one talks about low-cost deposits and so forth, the marginal cost of deposit is actually fairly high in this market, given there's a limited amount of savings. Okay? So that is one aspect which is not allowing us to lower interest or borrowing costs or interest costs, our own cost of funds, the bank's cost of funds.
Instability in Kenya's key trading partners such as Egypt, the country's leading buyer of tea in Europe, a key market for horticulture, has had exports. Remittances, on the other hand, have provided a cushion for the economy, reporting a 5% growth to $110 million in May.
Kenya has always been a great exporter of human capital. So while you're saying pockets in Europe and the US, maybe there's contracting economies, there are other regions of the world where Kenyans are getting employed. The Middle East is a classic example of this. So provided that's sustained, I only see those remittances going up.
Obviously, Kenya is becoming much more connected, especially with our neighbors. If you look at our growth in terms of exports, especially to the East African community, that's growing year on year. There's now talk of even more harmonization of the markets, much more better, more favorable agreements, much more opening of our borders. And especially, as Kenya also becomes, the financial hub of the region, we expect a lot more trade opportunities to exist within the region.
Kenya's exchange rate has fluctuated between 85.95 and 86.05 per dollar in June, a level the central bank is comfortable with. However, the high demand for imported goods poses a danger to the outlook of the economy, which the World Bank says will grow by 5.7% this year.
Treasury is talking about raising $1 billion through a sovereign bond. So we expect that obviously to come and support in terms of foreign currency. Also remember that if you look at the import cover, that has significantly gone up. At 1.23 months ago, we were sitting at about less than 4 months, which is a statutory level. We're now sitting at about 4.3 level. So I would say central bank has quite some leeway to be able to, even if it means coming to the market to sell a bit of hard currency to support the local shilling.
Clearly, one additional way to protect inflation over the long term is actually to build our industrial base, to build our own sustainable market where we're actually producing what we want locally as opposed to importing it in. Oil and energy are substantial costs for us, so any impact internationally on those prices or our currency has a massive impact on inflation.
With low interest rates on Kenyan government papers, banks are now expected to shift their focus to lending, which will stimulate economic growth.